In the investment market, there is one of the most dangerous misconceptions. As soon as people hear interest rate cut, they immediately think the stock market will definitely go up. But history tells us it's not that simple. An interest rate cut can either signal the dawn of a bull market or be the calm before the storm. Today, let's break down interest rate cut stock market rally. Hello everyone, I'm Alpha and you're watching Alpha Talks Finance. 1. The dual faces of interest rate cuts. Looking at historical data, the market outcomes following an interest rate cut depend heavily on the context. Rate cuts during recession or financial stress periods, they often confirm bad news. For example, after the dot-com bubble burst in 2001. The Federal Reserve started its rate-cutting cycle, but the S&P 500 continued to fall until the market hit bottom in 2002. Similarly, during the 2007 to 2008 financial crisis, despite quick rate cuts, the collapse of Lehman Brothers and turmoil in the financial system still led to a major market crash. In other words, rate cuts can't prevent the shockwaves of an economic downturn. Rate cuts during soft landings or mid-cycle adjustments. This is a different story. In 1995, the Fed made small cuts against a backdrop of healthy economic growth, which helped fuel the bull market. Similarly, in 2019, the Fed made preemptive cuts due to concerns over global trade tensions, and as a result, the S&P 500 surged nearly 30% for the year. This shows that when rate cuts aren't accompanied by a crisis, markets are more likely to rebound too. The dividing line after the first rate cut. Another study reveals a crucial pattern. The stock market's performance following the first rate cut often becomes a key turning point. If the economy is not in a recession, the S&P 500 usually delivers a positive return over the next 12 months. However, if the rate cuts are accompanied by an economic slowdown or recession, the market may face significant pullbacks. We need to understand that the rate cut itself isn't the key point. The key is the economic situation that it signals. 3. Common patterns in asset classes and styles. Interest rate cuts don't just affect broad market trends, they have differentiated effects on various asset classes and investment styles. 1. Small cap stocks. Small cap stocks are often the beneficiaries of rate cuts. The reason is simple, they are more sensitive to financing costs. When interest rates drop, the pressure on small cap stocks is alleviated, and coupled with the potential for economic recovery, they tend to outperform the broader market. 2. REITs and rate-sensitive assets. Rate cuts typically coincide with falling government bond yields, which boosts the valuation of real estate investment trusts. REITs. For instance, during the 2019 rate cut cycle, the US REIT index gained over 25% for the year. 3. Credit bonds vs rate bonds. During periods of monetary easing, credit spreads generally narrow, and corporate bonds often outperform government bonds. However, it's important to note that if the market faces systemic risk, like the 2008 financial crisis, even with rate cuts, credit bonds can still be hit hard. If the Fed does indeed start cutting rates in the next 3 months, do you think it will resemble the soft landings of 1995 and 2019, or will it be more like the recessionary backdrop of 2001 and 2008? Coming up, we'll dive into the impact of the Fed's rate cuts on the market and explore potential investment directions. If you found this video helpful, don't forget to subscribe to our channel. Now let's take a look back at 6 typical interest rate cut cycles in history and explore the lessons and insights we can learn from the market. As we all know, interest rate policy acts like the thermometer of the economy and a key market indicator. Each time the Federal Reserve cuts rates, it leaves a distinct mark on investment history. Some rate cuts mark the beginning of a bull market, while others serve as the soundtrack to a recession. Looking back at the past 30 years of 6 typical interest rate cut cycles, we can clearly see a real picture of both risks and opportunities. 1995, classic soft landing. Bull market takes off in the early 1990s. The US experienced a sharp round of rate hikes, leading to an economic slowdown. To avoid excessive tightening, the Federal Reserve made 3 small rate cuts between 1995 and 1996, totaling around 75 basis points. What was the outcome? The S&P 500 soared by 37% in 1995, kicking off a bull market. This period is seen as a textbook soft landing. The economy didn't fall into recession, financial conditions loosened just enough, and investor confidence was restored. Lesson: When rate cuts happen in a resilient economy, they act as a pick-me-up, not a painkiller. 1998. Emergency rate cuts. Bubbles lurk between 1997 and 1998. The Asian financial crisis, Russia's debt default, and the near collapse of the LTM hedge fund caused widespread panic in the financial markets. The Fed quickly cut rates 3 times to stabilize the situation. In the short term, the market rebounded and everyone breathed a sigh of relief. However, the loose liquidity also allowed the dot-com bubble to continue inflating. 2 years later, the bubble burst and the US entered another period of turbulence. Lesson: emergency rate cuts can calm panic, but they may unintentionally inflate the bubble of risk assets. 2001. The dot-com crash. Rate cuts can't save the market in 2000. The dot-com bubble burst. The Fed slashed rates from 6.5% all the way down to 1%, an unprecedented move. Unfortunately, by this time, corporate earnings were collapsing and investor confidence was shattered. The market did not improve with the policy change and continued to decline for 3 years. In this case, the rate cuts merely cushioned the economy but did not immediately prop up the stock market. Lesson: when the fundamentals worsen, rate cuts can't save corporate profits. Investors should be wary of the ineffective rate cut. August 2007. Extreme rate cuts during the financial crisis. The subprime mortgage crisis hit and the Fed slashed rates to near zero, implementing unconventional quantitative easing measures. Yet the market didn't rebound immediately. The stock market eventually lost half its value and only began to recover once the credit system started to heal. This episode taught us, if the financial transmission mechanism breaks down, rate cuts alone can't save the market. Lesson: rate cuts aren't a magic bullet. The real key is whether the credit system can continue to function. 2019. Mid-cycle adjustment. A bull year for the stock market. Trade tensions and economic slowdown in 2018 led the Federal Reserve to cut rates 3 times in 2019. Chairman Powell emphasized that this was a mid-cycle adjustment and not a signal of an impending recession. Indeed, the US economy did not fall into a recession, and the S&P 500 surged by about 30% for the year. That year, both stocks and bonds rallied, and investors enjoyed an ideal gentle easing. Lesson: if the rate cuts are preemptive and the economy remains healthy, they tend to be very positive for the market. 2024-25. A market betting on expectations. By 2024, the Fed had cut rates 3 times and paused. By 2025, the market widely expected another rate cut in September. Small cap stocks and real estate investment trusts, REITs, rate-sensitive sectors, had already responded, and the stock market surged ahead in anticipation of further easing. However, many seasoned investors warn that historically, when rate cuts actually happen, the market often goes through a buy the rumor, sell the fact volatility. Lesson: the market often moves ahead of policy. So investors should focus on trends in capital flows and expectations, not just the Fed's meeting schedule. From these historical examples, we can clearly see that interest rate cuts are medicine, not magic pills. If the economy is only slowing slightly as in 1995 and 2019, rate cuts can serve as a market catalyst. If the economy is already in recession or the credit system is broken as in 2001 and 2008, rate cuts usually can't provide an immediate cure. Short-term emergency rate cuts as in 1998 can stabilize the situation, but they may sow the seeds for future bubbles. Thus, the market's pricing often moves faster than policy decisions, and the real challenge is finding the balance between expectations and reality. Only by understanding the logic behind these rate cut cycles can we make more rational choices at the next turning point and ride the wave to success. I'll break down the most professional content in the simplest way, so you don't need a finance background to understand what's happening in the US stock market. If you want to improve your investment judgment and hear the true logic behind the market, feel free to subscribe. We've just analyzed 6 major interest rate cut cycles in history. Now let's dive into the winners and losers during these rate cut periods, once again looking to history for valuable insights. When the Federal Reserve twists the knob on interest rate policy, the entire financial market behaves like a lake disturbed by a stone, sending ripples across the surface. Some see opportunity, while others see risk. The key question is, which assets and styles can make it through the rate cut cycle and come out on top? Looking back at the past 30 years of rate cut cycles, we can identify 6 astonishing common patterns, each supported by real historical events. 1. Overall stocks. Rate cuts are not a magic bullet in 1995. Bill Clinton was still in the White House, and the internet hadn't yet gone mainstream. That year, after a year of tightening, the Fed made 3 small cuts, totaling 75 basis points. The economy didn't fall into recession but instead stabilized. The stock market immediately surged. S&P 500 shot up 37% in 1995, marking the beginning of a 5-year bull market. Fast forward to 2001 and the story was entirely different. The dot-com bubble burst, and the Nasdaq lost half its value in just a few months. The Fed responded by slashing rates from 6.5% to 1%. Investors thought it was a lifeline, but the result? The stock market continued to decline for 3 more years, with profits collapsing and confidence shattered. Rate cuts could not save corporate earnings. Lesson: rate cuts are only effective as a bull market booster when the economy is still resilient. If a recession has already set in, rate cuts are merely a buffer, helping the economy but not saving the stock market. 2. Small cap stocks. A magnifier of interest rate sensitivity in a rate cut cycle. Small cap stocks often act like they've been given a turbo boost. With financing costs dropping, these stocks feel the relief instantly. 2019 was a vivid example. The US economy didn't enter recession, and the Fed made 3 preemptive cuts. As a result, the Russell 2000 small cap index took off, outperforming the S&P 500 for a time. Small companies are highly dependent on financing, so when rates drop, their resilience is most apparent. However, this spring effect can also work in reverse. During the 2008 financial crisis, small cap stocks suffered even more than large cap stocks. The reason? When credit freezes and financing dries up, small companies are the first to get hit. Lesson: small cap stocks are like high-speed cars. They can easily overtake on smooth roads, but when a sharp turn comes, the risk of flipping is greater. 3. Real estate and REITs. The barometer for financing costs. Real estate is naturally sensitive to interest rates. During rate hike cycles, developers face higher loan costs and valuations compress. But once a rate cut cycle begins, the situation reverses. Between 2001 and 2003, the Fed slashed rates to 1%, and real estate investment trusts REITs became the market's dark horse. While the stock market struggled with the aftermath of the dot-com crash, the US REIT index rose over 20%. The reason was simple: borrowing became cheaper, and rental returns remained relatively stable, so investors treated REITs as a safe haven. Similarly, in 2024, when the Fed ended the rate hike cycle and shifted to an easing stance, small cap stocks and REITs responded early, climbing out of their lows. It's like history repeating itself. Lesson: rate cuts act as a spring breeze for real estate, especially when the economy isn't in full-blown recession, with REITs usually catching the first whiff of warmth. 4. High-yield bonds. The thermometer of risk spreads. If the stock market is the barometer of investor sentiment, high-yield bonds are the thermometer of risk. During the 2019 rate cut cycle, the US high-yield bond spread narrowed by nearly 100 basis points, and returns significantly outperformed treasuries. At that time, the market believed the economy hadn't entered recession. Risk appetite had returned, and corporate financing conditions had improved. But by 2008, the story was entirely different. The Fed slashed rates aggressively, yet the high-yield bond spread surged to nearly 2,000 basis points, and the financing market froze. It wasn't until the Fed rolled out quantitative easing that credit conditions began to recover. Lesson: rate cuts can ease the burden on corporations, but only if the credit transmission channels aren't blocked. The spread movement often reflects market conditions better than nominal interest rates. 5. Sector styles. The cycle of financials and defensive stocks. The impact of rate cuts on different industries can be starkly different. During a soft landing scenario such as in 1995, the banking sector often shines. As interest rates fall and the yield curve steepens, loan demand increases, making bank stocks the winners. But in a recessionary context like in 2008, banks become the hardest hit. Bad loans pile up and asset values shrink. Rate cuts can't reduce the cost of credit. Instead, defensive sectors like utilities and consumer staples tend to hold up better. Lesson: sector performance depends on the nature of the cycle. Rate cuts are just the switch. The strength of the sector is the real determinant of success. 6. Market sentiment. By the rumor, sell the fact. Market pricing often moves faster than policy changes themselves. A vivid example of this was seen in 2025. The market had already priced in a September rate cut by mid-year, with small cap stocks and real estate stocks surging ahead. But once the rate cuts actually occurred, the market didn't just shoot straight up. Instead, it went through by the rumor, sell the fact volatility. Lesson: rate cuts aren't usually the starting point, they're the realization point. The smart money has already positioned itself in advance. To summarize these 6 patterns, it all comes down to one key message: rate cuts are not the endgame, but rather a signal. If the economy still has resilience, rate cuts act as an accelerator. But if the credit system breaks down, rate cuts can only cushion the blow, not reverse the trend. Different asset classes each have their own resonance points. Understanding these rhythms will help you catch the real opportunities when the next rate cut cycle arrives, rather than being misled by the surface-level positive news. By now, you should have a clear direction for your next steps. But before you act, remember the lessons from history. Let me now analyze the 3 major traps and 3 viable paths during an interest rate cut cycle. For many investors, a rate cut is seen as the signal for the stock market to take off. But history repeatedly reminds us, rate cuts are never a guaranteed launchpad for a bull market. They can bring prosperity, but they can also signal impending crises. Understanding these lessons is crucial to avoid being misled by the market as surface-level optimism during the next easing cycle. Lesson 1. Rate cuts can't fix bubbles. Case study. The 2001 dot-com bubble. Do you remember the boom of the Nasdaq? In 2000, countless startups were soaring in the stock market, with even unprofitable e-commerce companies being hyped. But bubbles always burst. In the spring of 2000, the Nasdaq plummeted overnight, continuing its decline after that. The Fed acted swiftly, cutting rates from 6.5% to 1.75% in 2001. But what happened? The Nasdaq didn't come back to life. It dropped nearly 80% in 2002. Lesson: rate cuts cannot restore confidence once an asset bubble bursts. When investors rely solely on monetary easing to keep the hot market alive, they often end up stuck in a prolonged bear market. Lesson 2. Rate cuts can't fix a collapsing financial system. Case study. The 2008 global financial crisis. In the fall of 2008, Lehman Brothers collapsed, and Wall Street went into panic mode. The Fed aggressively cut rates from 5.25% to 0%. According to conventional wisdom, lower borrowing costs should benefit businesses, but the reality was far different. Liquidity froze completely. Banks were unwilling to lend, and businesses couldn't get money. The Dow Jones plummeted from 14,000 to 7,000 in a matter of months, and investors saw their wealth evaporate. Only after the Fed introduced unprecedented quantitative easing QE did the credit market begin to stabilize. Lesson: rate cuts can ease borrowing costs but cannot repair the trust crisis within the financial system. Investors must remain vigilant about systemic risk, which is the real lethal variable outside of interest rate policies. Lesson 3. The market often primes itself ahead of time. Case study. The 2019 preemptive rate cuts. In 2019, the Fed cut rates 3 times. But if you paid close attention, you'd notice that the real rally had already begun before the rate cuts started. From the beginning of the year until the first rate cut, the S&P 500 had already risen more than 20%. By the time the cuts were implemented, the market entered a phase of consolidation. Many investors, who bought in only after hearing the news, found themselves investing at the moment of the rate cut announcement, and their returns were not as high as they had expected. Lesson: the market is a machine of expectations. Smart money always moves ahead of policy changes. Investors shouldn't just focus on headlines. They should plan ahead. 3 paths forward. Investment wisdom from history. History doesn't just serve as a warning. It teaches us how to avoid the traps. By reflecting on past rate cut cycles, we can distill 3 actionable investment strategies. 1. Understand the nature of the cycle. If it's a soft landing scenario like in 1995 or 2019, rate cuts signal opportunity, and you can consider a more aggressive stance. If it's a recession backdrop like in 2001 or 2008, rate cuts can't save earnings, and defense is the better approach. 2. Focus on credit spreads, not nominal rates. Narrowing credit spreads are a sign that market risks are being repaired. Watching the changes in spreads is more reliable than focusing on the nominal interest rate. 3. Plan ahead, don't wait for the news. History proves time and again that the market has already priced in rate cuts before they are even implemented. Investors should assess macro signals like employment, inflation, and corporate earnings to gauge the rhythm, rather than waiting for the Fed's official announcements. History is like a mirror. It tells us that systemic risks can't be solved solely by interest rates. It also reveals the iron rule of expectations leading the way. The next time the rate cut bell rings, smart investors won't be asking, "What should I buy now that rates are cut?" Instead, they'll be asking, "Is this the start of prosperity or the beginning of a downturn?" Only by answering this question clearly can an investor truly navigate the next rate cut cycle with success. Practical tracking checklist. Weekly review of US stock market and key takeaways for investors. Hello everyone. Today, we're going to go through a practical tracking checklist. This is a framework that can be used monthly or quarterly to summarize market trends and identify investment opportunities. In this issue, we'll take a look at the US stock market's movements over the past week. Through specific events and stock examples, we'll break down the market rhythm and put you in the heart of the action. 1. Market overview. Between frenzy and calm, let's start with the major indices. Last Friday, the US stock market saw an explosive rally. The Dow Jones surged 846 points, hitting a new all-time high with a nearly 2% gain. The S&P 500 rose by 1.5%. The Nasdaq shot up 1.9%. This rally could almost be described as a market frenzy. Why? Because Fed Chairman Jerome Powell signaled at the Jackson Hole conference that a rate cut is very likely in September. The market immediately interpreted this as a positive signal, and capital poured in, with risk appetite soaring. Small cap stocks and REITs even saw a jump. However, by Monday, the mood shifted quickly. The Dow fell 349 points, down 0.8%. The S&P 500 dipped 0.4%. The Nasdaq saw a small drop of 0.2%. In just 2 trading days, the market moved from a frenzy to a calm state, following the classic logic of buy the expectation, sell the fact. 2. Sector and stock case studies. A ground-level observation amid this roller coaster market. Several cases stand out. First, NVIDIA, the market barometer. NVIDIA's stock price has risen over 30% this year, and almost every time the market goes up, NVIDIA is at the forefront. This week, it remained a key pillar for the tech sector. Investors are eagerly awaiting its earnings report, as NVIDIA is not just a stock but a representative of the AI industry chain. If NVIDIA's guidance surpasses expectations, it could ignite confidence in the tech sector and the broader market. Conversely, if it falls short, it may trigger a chain reaction. Second, Intel, a shot in the arm from the government. This week, Intel received large-scale funding from the US government, causing its stock to rise more than 5%. This shows that policy support can still directly influence market trends in strategic industries like semiconductors. For investors, this serves as a reminder that sometimes the connection between fundamentals and policy can affect short-term stock performance more than earnings reports themselves. Third, Keurig Pepper, the cost of mergers. This company announced an acquisition of the European coffee business JDE Peet's for $18 billion. The result? A sharp drop of 11% in its stock price. The market voted with its feet, signaling that investors weren't convinced by the acquisition. Why? Because a large acquisition could bring debt pressure and uncertain future returns. This case tells us that big news isn't always good news. What matters is how the market interprets it. Together, these 3 stories form a microcosm of the market. NVIDIA represents growth and expectations. Intel represents policy and industry. Keurig represents risk and interpretation. Doesn't it feel like you're sitting at the trading desk, watching stock prices flash and the market sentiment changing in an instant? 3. Investors tracking checklist. Use every month and quarter. So, as regular investors, how should we use a checklist to review the market? Here are 6 key points to guide your process. 1. Market performance review. Start by looking at the overall market's gains or losses and determine whether the market is euphoric, in a consolidation phase, or in a correction. 2. Interest rates and external environment. Pay attention to US Treasury yields, Fed statements, and key data such as the CPI and employment reports. 3. Sector rotation. Are small cap stocks leading the charge, or is tech continuing to support the market? Are there opportunities in financials and energy sectors for a catch-up rally? 4. Stock case studies. Select 3 to 5 representative stock events as samples of market sentiment. 5. Expectation vs reality comparison. Was the rally driven by expectations, or was it the result of fundamentals playing out? 6. Future signal tracking. Which data points or earnings reports should you be watching closely next? For example, the PCE inflation data set to be released this week could have a significant impact on the rate cut trajectory. These 6 steps serve as your navigation system for monthly or quarterly market reviews. Extended analysis. The systemic logic behind this week's market movements. 1. Recap, market frenzy and brief pullback. Last Friday, the US stock market experienced a surge. The Dow skyrocketed 846 points, marking a new high. The S&P 500 gained 1.5%, while the Nasdaq rose by 1.9%. The market's optimism was fueled by Fed Chairman Powell's dovish statements suggesting that a rate cut could be on the horizon. This caused a wave of positive sentiment. However, the market mood flipped. Rapidly on Monday, the Dow fell 0.8%. The S&P dropped 0.4%, and the Nasdaq also saw slight declines. This shift illustrates the market's short-term volatility and how quickly it can cool down after initial expectations are priced in. 1. Stocks and sectors. Key players in the market story. Nvidia. This week, Nvidia remained a market focal point. Its earnings report, which is expected soon, is likely to be a major test. If it beats expectations, it could boost the tech sector, but a disappointing result could spark volatility. Intel, the US government's investment in Intel has attracted attention, with the government now holding about 10% of the company's stock. While this government backing has boosted Intel's stock price, it also introduces policy risk and future uncertainty. Pepper. The announcement of the $18 billion acquisition of JDE Peet's led to a sharp drop in Curryg's stock. This is a classic case of news not always being good news, where the market's interpretation of the acquisition outweighed the announcement itself. Other sectors, small-cap stocks, construction, and other sectors saw strong performances this week, with the Russell 2000 index rising nearly 4%, indicating accelerated capital flows into sectors that depend more heavily on financing. Meanwhile, transportation, energy, and financials strengthened on rate cut expectations. 1. Deep dive reading recommendations. T. Rowe Price Global Market Weekly Update focuses on market rotation logic and notes that Powell's comments sparked optimism, but the tech sector faced pressure as funds flowed into energy, real estate, financials, and commodities. Fidelity Weekly Market Update. This week's update highlights the Fed's continued dovish stance, pushing the market higher, with a parallel rebound in Bitcoin and Ethereum, reflecting a broader rise in risk appetite. Ameriprise in-depth analysis on Nvidia and big tech risk premium discusses how, despite high valuations, the big tech stocks, especially Nvidia, are supported by strong earnings. Nvidia's performance this week has outpaced the S&P 500 by 32.5%, a much stronger return than the broader market's 10% gain. 1995 and 2019 were periods of prosperity. 2001 and 2008 were times of crisis. What kind of story will 2025 write? At Alpha Talks Finance, we will continue to track market data, company earnings, and policy signals to help you see through the rate cut mirror in real time. Now, here's the question for you. Do you think this time feels more like 1995 or does it resemble 2008? Leave your answer in the comments. Perhaps it will become a historical footnote in the future. This is Alpha Talks Finance. See you next time.